AI is something that has been invoked literally at every single panel. AI, AI, AI. I am so excited to have a great balance of both government officials and tech companies in AI, in the AI space, who are literally working together to figure out what the next steps are for the technology. So thank you very, very much to our next panel. We're really excited.
Hello, and it's a pleasure to be with all of you. My name is Madeline, Fredin, and I am here representing Alloy Labs, a consortium of community banks. And this topic, AI, has been as buzzy as any over the last couple of months. And I think that the breadth of content on this topic far exceeds the amount of time we have between this panel and lunch. So we are going to try to focus it. We have a couple of topics that we're going to get into today related to fairness, related to the agency and responsibility with regards to AI, and then also looking at AI at scale. But we're going to look at all of these things on a spectrum that exist both from an ability to create opportunity as well as an opportunity, as well as on the flip side, the more risk-averse side. But we are going to try and hold both of those things in tension. But that's the framing for this. You have your orientation. But I'll let our panelists introduce themselves, and then we'll get started.
Hi, everyone. I'm Georgina. I'm the founder and CEO of Solo, not the one being sued by the CFPB. I feel like I need to clarify because I just heard that 10 minutes ago. We are a consumer data collection company for banks to automate the underwriting process. So anything from document collection to connecting bank accounts, we handle.
Hi, everybody. I'm Jeanette Quick. I'm Deputy Assistant Secretary of Financial Institutions Policy at the U.S. Department of Treasury. That means I oversee two offices. One is the Federal Insurance Office, and one is the Office of Financial Institutions Policy, creatively named, which focuses on policy related to all sorts of financial institutions. So that includes banks, credit unions, fintechs, primarily, but all sorts of financial institutions. Previously, I worked in fintech. I led legal compliance public policy functions at a company called Gusto, which is primarily a small business platform, and a smaller company before that. I also spent time as a congressional staffer and at the OCC, so have sort of been in and out of the private and public sectors. Thank you for having us here.
Hi, John Sun, co-founder and CEO at Spring Labs. We are a generative AI company that helps banks and financial institutions better understand what their customers are trying to tell them through complaints using generative AI to help analyze, process, and manage complaints and disputes, which really, if you think about it, is kind of a window into what's going right and going wrong with your interaction with the customers. Previously, was also in fintech. So before Spring Labs, I was the co-founder and chief risk officer at Avant, which is a unsecured consumer loans and credit card company based in Chicago.
My name is Pankaj Kulshreshtha. I'm the founder and CEO of Scienaptic AI. We are in the business of enabling financial institutions to use the latest and the best possible credit underwriting decision techniques through our software as a service offering. It enables us to use more data into the decision making that enables us to give out credit to folks that might not have a lot of information on their bureau and so forth. We also use more advanced context adaptive type scores and strategies that enable us to take the context of the lender in the account. So for example, if somebody is lending in Wyoming versus New York, you need to apply a different set of criteria depending on the macroeconomy they are operating in. So those are kind of things that our platform does, but glad to be here.
Wonderful. All right, we're going to start with this topic of fairness. So I would say when I speak with banks and they are expressing some degree of fear in adopting AI into their processes and especially into their decisioning, the biggest question and pushback that I get is, but AI, we can't know that AI is fair. We can't know that and ensure that these models are going to be making unbiased choices and not only, obviously, we have regulation to contend with, but we have customers that we want to be fair to. So I'd love, maybe we start down at the end, and to speak to, what would you say to a community institution that says to you, I couldn't possibly embrace AI because I don't believe it would be fair to my customers?
Right. So AI, I think I tend to think of myself as the geek typically, and I'll talk about AI, try to talk about AI in an eloquent way. But today, actually, Senator has done it, and then after that, Scott was there. They have talked very commonsensically about AI, and I think that's the right way to think about AI. I think the biggest thing that we have to understand with respect to AI is there is machine learning piece of it, where you're using classic quantitative data that is available, like credit bureau information, LexisNexis information, any of the fraud scores that are becoming available, and so forth. Those technologies have existed for 30 years, 40 years or so, and the regulation has existed about how to use those technologies in the fair, robust way that supports the customer welfare, basically. Now, the whole discourse that has shifted recently, last year or two, basically is around use of natural language processing, where there is a significant level of smartness and intelligence that has come in because of generative AI. And that is a whole different subject that I think John and others in the panel should talk a little bit more about. But I would just say that, for example, what we do at Scienaptic AI, it is supporting credit underwriting decision. It's regulated in a very robust way for last 50 years, basically. There is Regulation B, which basically makes sure that financial institutions are using the right kind of information about the customer and are not discriminating based on race, gender, ethnicity, any of those kind of areas, really. And as long as we have a system that actually follows the regulations that are laid out in this specific space, I think our consumers, or we as consumers, are safe, really. And technology should actually become a lot more smarter in terms of using better algorithms and use better data to be able to do what the regulation intends or has intended for a long period of time for financial institutions to do.
I love that, because you've already started to hint at the opposite here, where it's like, how actually do we leverage AI to become more fair in our processes? And so I'd love for anyone to speak to that question, as far as as you think about, like, what does radical fairness look like? Like, from the customer's eyes, from the regulator's eyes, what would it look like to have a system that was perfectly fair, and how might AI actually be helping us achieve that vision?
Yeah, I mean, I'm happy to just give my 2 cents there. I think the first thing to kind of recognize is that, whether we like to believe it or not, humans aren't inherently fair. I mean, I think that's kind of the challenge with redlining and all of these issues that kind of happened when you trusted humans to make decisions kind of on behalf of your organization. So I think there's an opportunity to improve on that, because we've already seen that improve from the advent of automated underwriting models, like logistic regression models back in the day, to like gradient boosting based models. And we're not quite there with generative AI making decisions on behalf of the bank, or making decisions on loans or anything like that yet. But I'm sure one day, whether that's a few kind of years or more from now, we will be. And I think there is definitely an opportunity to make sure that the technology, like to your point, is conforming with whatever kind of outcomes we're looking for, right? From kind of a disparate impact or whatever perspective. So I think rather than looking at these technologies with kind of a degree of fear and saying like, well, how do we know this is fair? I think we kind of start with a baseline of, we know the existing process isn't fair. How does this improve on the existing processes?
And I would just add to that very quickly, if I may. Again, the framework is quite set there. So for example, when the regulators come in for the examination, there is specific reporting they would like to see in terms of how the particular financial institution is handling different protected classes. So these protected classes are gender, race, age, and so forth. To the point John was making, there is definitely a systemic unfairness, in the sense that there are more approvals in certain groups over the others. But what the regulators require us to demonstrate, or the financial institution to demonstrate, is that with the new tools or with the new models that you're using, or AI or machine learning or whatever you want to call it, you are reducing the discrimination and you are able to get more customers in. So in our work with over 100 institutions that we work with, we get lots of stories. And in fact, the senator was from South Dakota, where we have a customer actually, and they have basically, they have recorded now for us really a video where they're talking about how using the Scienaptic technology, they are able to give out more credit to Native American communities there, because the kind of data that is available about them is not as rich on the credit bureau. So you have to use alternate data sources and better algorithms. So that's my last plug on Scienaptic. But
I love it. We know that, to your point, that these systems aren't perfectly fair, and we're not going to snap our fingers and suddenly move to a system that is. So in the messy middle, where we're moving toward greater AI adoption, we are probably going to see false positives, where the systems are not behaving and decisioning fairly. I'd love to hear some ideas related to, what kind of options for redress do you give to customers who are caught in the middle of these decisioning processes and are now maybe accusing institutions of acting unfairly to them, or experiencing that kind of, being on the receiving end of that?
I think, there's been a lot of progress on being able to automate the assessment frameworks that banks are using to make decisions. And Scienaptic's a good example of that, and having context-aware decisions being made. I think that not as much progress has been made on the data collection side, where recently the CFPB came out with the final 1033 ruling, which talks about essentially fairness in credit reporting. And I think when we go back to what it means to be fair and have systems that promote that fairness, I think it starts with not necessarily what the decision and output is, but what's going into it. And so, the parts that we focus on at Solo is making sure that the inputs into whatever decision the bank is going to make is a holistic 360 on the customer, and that the customer has visibility into what's being presented to the bank. And with that, they're able to fill in the gaps and kind of advocate for themselves using standardized and verified ways of providing data to the bank that could potentially change the outcome. I think in the past, the credit bureaus have not necessarily acted in this transparent way. And so I think that on the data collection side, and now with open banking, I think that's like a good starting point for fairness and just everyone being on the same page of what information's even going into these decisions.
Are you seeing an uptick in customers wanting to provide more data to financial institutions who would say, I have nothing to hide, I want to reduce the asymmetric information in this decision, and I'm willing to open the doors wider for you if really these decisions are coming down to data more often than not, than maybe historically it was more relational in decision making. But have you seen any trends in that way?
Yes, I think that banking historically has been very relationship based, and the more that your banker knows you, it's almost like trust by proxy of how much information is available. And I think that open banking has given us an opportunity to scale that knowledge. I think it's all about incentive alignment. So I think for consumers, if they know that providing access to information will not only potentially change an outcome, but also give them visibility, almost like a roadmap into what they would qualify for versus just having no idea what's going to happen and at what point their application will be kind of ruled out of the system. I think that there is more of a collaborative discussion happening now around open data sharing.
I also think that this is where, whatever you want to call it, AI or more advanced analytics or things like that have to come into play so that we can optimize the customer experience. Because I think the trouble is when these new technologies come, we start deploying them at the financial institution, and then they impact all of their customer base. And what that means is that, people in this room, this point was being made that, the population that we are talking about from an inclusion perspective is not in this room. We are not representatives of that. We get like 5 offers every day in our mails, every week, if not every day, and we don't even open those envelopes, and we just junk them, really, right? So if you just deploy these additional technologies there, it doesn't work. So we have to sieve these technologies or orchestrate these technologies in such a way that they get applied to the cohort where they actually create the incremental value that, Georgina, you are talking about. So there is a very direct relationship to the fairness and use of technologies with the customer experience as well.
Can I add a little bit just from like the government perspective? So a couple of months ago, we published a request for information on the use of artificial intelligence in financial services. And in that RFI, we asked a number of questions about this question of fairness, which we think is critically important to understand, both sort of as a government agency, but also I think in sort of understanding where the industry is and use cases, and thinking about how the industry thinks about fairness. The RFI closed in August. We're currently reviewing the responses and hope to publish something soon. But we received about over 100 comments, which was from quite a range of fintech companies, traditional financial institutions, consumer advocates, industry groups. It was a broad range. So I think we learned a couple of interesting things, and I think some of which has been touched on here, which is that fairness is important, and there are questions about sort of impacts of AI on communities that may have been traditionally underserved, right? And so there's, I think to my colleague's point here, there is opportunity for inclusion to sort of increase, right? There's sort of like use of alternative data, use of new forms of data and machine learning to sort of increase the credit box or access to financial services. And then there's also, the opportunity for existing biases and use of data to exacerbate issues, right, that we have seen in financial services for some time. So that's something that I think that we'll need to continue to watch and study. And I think, it's been clear from the financial regulators that many of the existing frameworks, like what was mentioned here, the Equal Credit Opportunity Act, Fair Credit Reporting Act, lots of other sort of fair lending laws and other consumer protection laws continue to apply. Some of the interesting themes I think we got from the comments was that there was there's mention of that these laws apply, but there's also some, I think, feedback that we received from industry participants that they're not really quite sure how it applies, or sort of how to evaluate disparate impact. How do you sort of make consumers understand the information that's being used about them? And if you look at sort of the traditional notice that is given to consumers in like the Fair Credit Reporting Act context, for example, where traditionally a consumer would get a very specific piece of paper that says the factor that was used about you that was derogatory was this, right? And it used to have very specific targeted information that could be pointed to, and a consumer could then appeal or sort of try to correct that information if it was incorrect, right? And there were certain rights that were granted under Fair Credit Reporting Act to consumers. And we're seeing that sort of framework is, it's may not quite work, right? I think the CFPB has made clear that that the existing laws are meant to be adapted to new technology, but I think there sort of is more to be looked at and monitored to figure out, how does that sort of resonate or align with what industry understands their obligations are.
I love that perspective. All right, we're going to move on to our next topic, which is about the potential for greater agency of AI in overall banking processes. And again, we'll treat this as a spectrum, where if the one side of the spectrum is maybe modern day banking, where a lot is really just done through humans and staff level, versus on the other side of this spectrum, you have an entirely digital workforce that is operating the bank autonomously. And so again, this is a spectrum. And I think that when we consider this, yes, there is extreme risk in managing that level of agency, but there's also a lot of opportunity. I think there's whispers on the street of like, are we finally in an era where a 10-person team could run a $100 billion company? And so there's a lot at stake here, both from an opportunity as well as a risk. And so I'd love some hot takes from the panelists here as far as when you consider the level of agency of AI in making decisions and participating in the operations of a financial institution, what are your opinions? Share about where you see the most opportunity and what risks are really top of mind for you that you would want to bring forward for discussion.
Right. So at least I can talk about myself. We take a view that the most evolved and intelligent systems are the ones where there is a combination of machine learning and then human judgment on top that is doing the alignment between these two layers in a very regular, consistent, and robust sort of way. Really. That's how we think about the way to design these systems. If you think about agency, I'll give you an example, and I think John here just made this point. Humans are often a lot more biased, right? So by the end of the day, 4:30, we are tired. Imagine a human underwriter who just wants to go home, and they have a credit application. All kinds of biases and heuristics come into the play. And I'll give you a real example that one of our credit union clients in Michigan actually gave. The chief lending officer actually gave that example. And she was talking about this application that came from, underlying business was a fishing business, really. So the lady underwriter who was there, she immediately jumps up and says, no, this is not going to work. My dad was in fishing business, and my brother-in-law is in this business. I know how those businesses work. Let's reject it, right? And that's where the fairness just goes down the drain very immediately. This was not ill-willed, right? I mean, this was with the good intention, really. So what we need to do is we need to make sure that data-driven, robust decisioning, all that work that we have done to make sure that there is a very significant qualified decision support given in the form of scores and decision recommendations is actually working and is actually used more often than not. That's also economically a better way to do these things. So if you think about $10,000, $20,000 type loans, really, you really cannot afford, based on the unit economics, to make a decision, to have a human being make a decision and take half an hour to make the decision, because the math just doesn't work financially, really. So really, you gotta use algorithms, but you gotta make sure that you have a framework by which all of these models that are being used to drive decision support are robust. And again, current regulation actually really does a very adequate job, in my opinion at least, of doing that. And then it is about just tracking it a lot more regularly. One of the things that I see happen oftentimes from a regulator perspective is a whole lot of institutions, when they are near exam, they'll hire a bunch of consultants and do a whole lot of work, basically, to put it across to the regulators. And I think that's just not the right approach, really. So one of the things that we are doing is we are saying there is a digital cockpit. Once you plug in Scienaptic into the, and I'm plugging in Scienaptic again, in spite of my promise not to, but really once you plug in the system, what happens is you have this digital cockpit that'll actually give you fair credit report by protected classes every day. It gets updated every day. So if you're running this as a business process and watching that data as financial institution process owners, then you will know when to change it, and the system will become a lot more finely refined, actually.
Any other perspectives on the responsible oversight of humans in the loop? How do you balance the temptation for the kind of scale and cost savings that come with, leveraging these models, with also the need to keep people in the loop? Any other perspectives on that?
Yeah, I mean, I think just to add on to that, really more looking at it from the generative AI perspective, I mean, I think you're absolutely right on the machine learning, how does machine learning fit into the kind of bank enterprise decision process. More on the generative AI side, there's some pretty interesting opportunities here. Just because I think, I'm sure everyone's kind of seen the articles of these Gen AI companies hypothesizing, like, can Gen AI models replace your CEO, and stuff like that. Obviously, it's in their best interest to kind of stir the pot a little bit and talk about these types of topics. I mean, certainly, I think AI agency isn't quite there. But what you are seeing is that generative AI brings a unique set of capabilities that allows it to mimic lesser human decisions in a way that's much more consistent and reliable and accurate over time. Like for instance, we use generative AI, and this is kind of one of the many, many use cases for Gen AI out there in the financial services world. We use it to process complaints, but to better help companies understand what's going on in a particular complaint. And there's some micro judgments in there that humans are kind of making today. Like first of all, is this conversation even a complaint or a dispute, or is it negative feedback, or is it nothing? Right? That's a small kind of human decision that's kind of being made. Or like what potential rules violations or risks or allegations are there. And these are the types of things that we're starting to kind of see Gen AI be able to kind of do a little more consistently. But on the whole, I think we're still in the phase of Gen AI where the best use for Gen AI is to support and augment human capabilities instead of to replace human decision making. We're just not at the model accuracy necessary to kind of replace any major subjective human decisions yet. And that's kind of based on data that's been in the market for folks trying to replicate major human subjective decisions rather than these kind of smaller like micro decisions.
I think that PPP gives us an interesting case study as well, because on the one hand, I think the industry pats themselves on the back of like, look at how fast we deployed capital. Look at how we rallied. But I also think, and I think you brought this up when we were talking earlier about the chilling effect that it's also had on some of these more automated lending procedures, just given some of the fallout from organizations that were a little bit too hands-off in how they were able to process and approve requests for capital. And I do think that it creates a little bit of a picture of like, wow, the speed, the availability of capital, like, yes, that's a vision that we have for the industry, for inclusiveness, for access, but at the same time also kind of that fear in the as you mentioned, that chilling effect on embracing some of these. Do you feel like overall that fear is keeping financial institutions back from doing the kind of exploration that they need to keep moving the industry forward? Or do you think that as an industry we're being responsible, we're moving at an appropriate pace? I would love for anyone to speak to the pace at which we're exploring some of these new technologies.
I think, from where we stand, we service both fintechs and banks, and I think that the appetite for kind of what we're willing to experiment with is very different on the fintech versus bank side. I think on the fintech side, where, the fintechs are I call them like martyrs for progress in some ways. Like I think that fintechs, by mandate, are able to take on more risk, automates the process end to end, really focus on the efficiency and the scale, whereas banks just can't afford that same risk level. I think that it's a spectrum, like you said. I think that on the bank side, where there is more appetite around AI adoption, is in the very clearly like robotic tasks. And so what AI I think is really good at is reading a certain document type and being able to identify exact data points that you're asking it. So being able to like read a financial statement and identify that the operating income is X. Whereas like traditionally, you'd have a banker switch between 14 tabs to get to just be copy pasting things from documents into a spread. I think that there's definitely more appetite around tasks that are very clearly robotic and don't require judgment, versus I think on the decisioning side, it's the fintechs that I think have been kind of martyrs of that progress that we've made as an industry, and some of them have been very successful in their case studies that then banks are willing to watch and see what happens and then decide if they're ready to adopt. I don't think that the banks are the first to swim into like an end-to-end automated decisioning process that requires human judgment at times.
I'll just add in, I think that sort of based on the amount of money that's going to AI from Silicon Valley, that there's not a chilling of innovation on artificial intelligence. I think one of the things that we learned from the RFI was that there's a lot more sort of ubiquity of use cases in financial services and AI, right? I think there had been sort of a lot of well-trod information about the use of AI in fraud and cybersecurity. We previously put out a report this year about that. And there are some very sort of clear and sort of strong use cases there in KYC and some compliance management. But we're also seeing that there's a lot of usage of AI in sort of top to bottom, operations. We're seeing, of course, there's like sort of customer service chatbot type functionality, but I think also just sort of more specific and targeted customer relationship management, more specific marketing of products. There's sort of more sophisticated use of AI in really many different functions within financial services companies. So I think that's something that we'll probably likely continue to see happen. And I just want to put in a quick plug on the last question around oversight of these systems. I mean, I think, just to mention that there are a number of existing regulatory guidances related to model risk management. There are a number of rulemakings and guidances that have been put out by regulators, both at the state and federal level, that I think we would expect to see companies sort of try to figure out how to make sure that they're compliant with those.
I would just add example. 25 years ago, when I was starting my career, a senior business leader in financial services business I used to work with used to draw this thing called perpetual money-making machine. And the box basically entailed a whole lot of models, right? So there were propensity models to target customers. There were underwriting models. There were servicing models. There were collections models and so forth. And really all you did was you have a machine running all of these models. A whole lot of data is coming through. And you have a bare minimum servicing bit that you have to do below that, which is totally outsourced. And really you pump in capital into that, out comes profit, basically. That was the model that he was building. And really, actually what happened was, in a couple of years' time, these guys built out a couple of $1 billion worth of loan book. Everybody went on the cruises and stuff like that, got awards and stuff like that. And then the story played out. And after a couple of years, losses started showing up, and we ended up losing 1/3 of that book in the losses eventually, really, right? So one of the things that we have to remind ourselves when the topic of scaling comes of financial services is lending is easy, collections is hard. Lending businesses are fundamentally about collections, not about lending. So the methodology for doing that, which I think some of the fintechs obviously should test, because that furthers the growth, drives inclusion, expands the credit access and so forth. But I think there is a methodology that you have to follow. Otherwise, you can burn a whole lot of capital. And then, as we all know, the pendulum of the VC world will swing from one side to the other side. And I don't like, as a risk manager, that's not the world I want to be in, where things keep fluctuating very significantly in terms of capital availability to financial services.
Appreciate the example. All right, we'll ask somebody to have the final word here on this topic, but I think we've been looking at these spectrums of, there's extreme opportunity, but then there's also, extreme risk in engaging with these. And so as far as wrapping up this conversation, I'd love, a word of encouragement from anyone for our participants today as we try to navigate these spectrums and find ourselves at the proper place to, maximize, to remain competitive, to continue to participate and create opportunity, while also managing all of those risks. So wisdom, anyone have a word of wisdom for us as we wrap up?
I'll just say, as a government person here, I think I would encourage you to engage with your regulators, engage with Treasury Department or other agencies that may be relevant to your companies. I think sort of helping us understand how you're using AI, helping us understand how it works, what you're doing to sort of validate data, how you're thinking about these questions about fairness and transparency and consumer protection, I think is very helpful. And so we do things like the RFI to understand what is going on out there, and to be able to make smart regulations or smart decisions in how we think about policies.
Wonderful. All right. Thank you.